who's amazing. We actually met in the digital world and met in real life for the first time, so I'm so happy to have you. I'll heed to you.
Sorry, what did you say?
I'll leave it to you.
Oh, gosh. Sorry. I feel like it's...
Yeah, just try to keep the mic as close to your mouth as possible, and that typically will help.
All right, so I'll do a brief introduction as the light's blinding my face. So Tiffany Miki, I'm a founder of an OCIO firm, outsourced chief investment officer firm, which basically means we manage portfolios for institutions, investment portfolios, so foundations, endowments, and pensions. And I'm also a CNBC contributor, so just talk about stocks and investments on TV every single week. So that's it.
Well, we already heard from Tushar and Rob. Christy, would you like to introduce yourself real quick, and then Tiffany, we'll kick it to you to ask us some questions.
Yeah, hi, Christy. Not sure what hat I'm wearing today, but most of you know me from the mining space. Technical advisor for a few companies, and also an open source contributor, and I am also moonlighting as a protocol dev at the moment. I will leave it up to you to guess which protocol.
Go down the line, or just me?
No, yeah, go for it.
Okay, so I'll just kick off kind of like our discussion. So in the world that I live in and that I work in every day, a lot of things that kind of touch Web3 are just very confusing, right? So I think that some of the, if we can call it like lack of adoption, is from confusion. So I just want to hear from some of you about really like the difference between like Web3 products and Web2 products in the area that you guys are working in.
I can start. So Celsius, as some of you may know, it's a CeFi and DeFi platform. It's really a cryptocurrency platform, and you can do pretty much all of the services that you can do with a traditional bank or a traditional financial institution. So things like bringing your crypto in, earning interest, which is called yield on it, take a low percent, like 1% APR loan on it, and swap from one cryptocurrency to the other. And then soon we are going to be introducing a credit card, and then further down the line, a debit card and prepaid card as well. So the way we think about moving from the Web 2 to Web 3 world is Celsius kind of today sits in what I would call a Web 2.5 world. So it's got 1 foot in Web 2 and 1 foot in Web 3. And really what we try to do is make the experience as seamless as possible. That's the best way to get more adoption of users. So that can start with your onboarding experience, the initial user experience, the kind of messages that a user gets, just hand-holding users through the entire experience. And what we've noticed is, and this is from our growth experimentation, is when people go through the first 10 days, and they're given the first 10 days of their life on our app, and they're given the right amount of hand-holding, whether it's through emails, it's bringing them back to the app, helping them on-ramp their cryptocurrency. Once they're done with that first 10 days, we have a weekly interest, weekly reward. And what that does is the first time you get this, almost the dopamine hit on your crypto, on the Monday when you get your interest. It might be small. I don't know how much people bring in, anywhere between $1,000 to $1 million on the platform. And depending on that hit, now you feel like, okay, this is like passive income. A lot of the cases what we've seen is users actually take their crypto out from the platform. And I think all they're trying to do is figure out if we create friction, if this is real or not, and if they can get their money back or not. This is, again, we're talking about mass adoption. We're not talking about people that are at the forefront, at the tip of the spear on innovation. These are people that we're bringing along, the mass population that is still trying to figure out what crypto is. And so what we internally call those, we made up this term called trust deposits. So those are not really our deposits to keep. Those are trust deposits that the users are making in us. So they'll make $100, they may be making like $200, $150, and they take it out. And then the third time they come in, they'll come in with $5,000, $15,000, $20,000. And what that means is we've been able to get over this threshold of trust. And again, I think I said this on the previous panel, when people think about financial services, trust really comes from being able to have a seamless experience that shows people that this is a real company with real technology, privacy, security in the back end, but also has a seamless user experience for people to transact.
Okay, so let me just talk about the difference between Web 2 and Web 3. The easiest way to look at this is, you know, in Web 2 you would log in with your email address and password, or your Facebook account, or your Google whatever, plus whatever that was at the time, and you would connect using that way. So Web 3 is using your wallet as identity, essentially. And so connecting with a wallet, connecting with a MetaMask or a Phantom wallet or whatever, and then managing your security yourself with your private key. Web 3 is about, whereas Web 2 you would tie your entire identity, through that login, through Facebook or whatever. Web 3 is more about you being the self-custodian of your identity. And it's also about you being able to participate in somewhat of an economic engine. That's where things are going.
But in order for you to actually be self-sovereign and own your identity, you need to own your data. And today you don't own your data. Even with, log in with Ethereum, you're still not owning. Like, let's take NFTs, for example. How many of you have purchased an NFT? Give me a show of hands. Great. Do you know what you actually own?
A receipt.
A receipt, exactly. You own a receipt. The original question was, what is the confusion between Web 2 and Web 3? No one understands what Web 3 is yet because it's still in that experimentation phase. We're still trying to figure out. It's a mixture of network effects. It's a mixture of trying the concept of owning your own data, and yet most of Web 3 is defined on Ethereum, where in reality it's the smart contract that owns the things that you're purchasing. It's the smart contract in the network that sets the rules. It's still trying to be figured out, and that's, to me, and to quote Mr. Nick Hansen for his wonderful tweet yesterday, Web 3 is not what we're currently being sold. It's all about taking back ownership of your data from the bigger companies and being able to choose how and where you sell it, and being monetized for that. And to get to that road, it's going to take a lot of work, not just technical work, not just product integration work, a lot of legislation as well.
Well, I also say not just legislation or technical or product work, but just like psychology, right? Changing consumer behavior is very difficult. It takes a lot to change consumer behavior. Time, or maybe, I don't know, a world-defining event like a pandemic. But, I don't know that we need to be in such a rush to get people into Web3. Web3 is, for me, the way I like to think about it, it's something where we forgive poor user experience for like this notion of like being in charge of your own data, etc. How many people were upset about Cambridge Analytica and Facebook and are still on Facebook? Or how many people from their Instagram said, I'm deleting Facebook? So I don't know that people, from an average consumer standpoint, care as much as about their data as they say they do. But I do think that that's a consumer behavior that will change over time, that in time more people will understand and start to care about overall. I do also think that there's always going to be a group of individuals, and I think it'll be the mass, that will always have intermediaries or call it custodians, or taking care of their finances, et cetera, for them.
I also think. Okay, this is done. Oh, here we go. So I also think. So I've heard security and safety and trust. I've heard like owning your own identity, and first of all, by the way, this concept that none of us own our digital identity, I think is lost on the masses. That people think you can log into your website and it's your website, or you can log into your social media and it's your social media, and it's the fact that it's not ours. It does not belong to us. All of our digital presence belongs to someone else and is owned by someone else, and someone else gets to determine whether we are real or not, right? And then of course, like I always think about things at the intersection of like technology and where the world's going, but also with making money. Of course, this is what I do for a living. So when you have like traditional Wall Street and leaders like a Warren Buffett or Charlie Munger, who's his partner, really seen as some of the best investors in the world, and he comes out and he says, I literally just do a Google search next time you have a free moment, Charlie Munger blockchain comments. And all of these things come up, and he's talking about how blockchain is used for like terrorists and money traffickers and all of this like horrible things that of course none of us want to be a part of. So how much of this like stigma kind of infiltrates your businesses and in addition to like the lack of like the confusion and lack of real information, how much of this stigma is kind of like affecting your work? Anyway.
I can answer that. Look, I would say that that stigma comes from a good place, right? It comes from a place of experience and inexperience or lack of curiosity about the space. But with that said, like 97% or maybe 98% of all crypto projects tend to fail. And the issue is that these projects are mostly funded by consumers who basically get the screwed, I guess, in the end, by things like like Luna is a great example, right, of something that makes promises of returns that are unsustainable, and then over time it resembles a Ponzi scheme, and there it is. Whether or not the intent was there when they created it doesn't matter. A Ponzi scheme is a Ponzi scheme. If user growth stagnates or we hit a bear market, this is when all the Ponzis get exposed. And then on top of that, you have like unclear regulation. I don't care what any lawyer says about regulations getting better. I know by experience that a legal opinion that you get from a big law firm is only as good as the paper it's written on. It's a complete waste. And the reason I say that is because a regulator, if they decide they want to go after you, they're going to go after you no matter what. And they're going to have their own opinion on what is a security and what isn't a security. So all of that stuff is why people like Charlie Munger say, that it's toxic. And they're wrong. At the end of the day, they're fundamentally wrong because there are some really, really good light at the end of the tunnel, and great projects, great companies emerging over time, which will be some of the largest companies in the world in the future. So it's sort of like looking at the internet days, back in the early 2000s or whatever, when people were dismissing pets.com and amazon.com, and then eventually, you see Amazon's the largest company in the world. This is what we're seeing now. The only thing I would say about crypto that's a little bit different is because of the lack of like clear regulation and because of the opportunity that exists, there are a lot of scams out there and even ones that aren't draped as scams, but they kind of are, and it sucks. It sucks to be part of that. But at the end of the day, if you're convicted and you're building something really great, really good VCs are going to get behind you and they're going to support you, to build on that vision.
Yeah, if you actually look at the historical arc of any industry, right? In the early days, when a new industry is just growing, there is a very high likelihood of bad actors being in that industry. So crypto right now is still, and really blockchain and Web3 products are really nascent at a point where there isn't the mass adoption quite yet. There isn't the financial literacy or even education about the risks and dangers quite yet. And what that does is, to a certain extent, does attract bad actors into the space. And what you hear in the headlines are these sort of bad projects or bad actors, and what you don't see is the underlying goodness that's happening within this blockchain, where it's truly based on a set of values and guiding principles, right? On like, I think I own my own data. I should be able to privately and in a secure way transact. I should have the right to be able to voice my opinion without getting blocked, right? All of these are really guiding principles of what Web3 is supposed to be. And while it attracts some of these sort of bad schemes, let's call it, and some people do fall for these schemes, largely there's a lot of goodness happening. And then the flip point when someone says like, oh, there's a lot of sort of anti-money laundering that might be happening, or sorry, money laundering that might be happening, when there's no real know your customer, AML checks, that would happen in the traditional finance world. The one thing that I point them back to is like, it's actually the most transparent transactions that you can see on the blockchain. Anyone can go in and actually see a wallet-to-wallet transaction by themselves. So it's actually the most transparent one if you know where to look.
I have a little bit of a different take, and hopefully no one will get angry at me because it's a bit critical at crypto. I think a lot of the commentary right now in the current bull market is deserved about crypto being a scam. And I say this as someone who's seen the different cycles. I think that the issue is people, ultimately. Web3 is focused so much on individuals and humans themselves, like the humans behind the company, the team behind a company, individuals making decisions instead of what was always the promise, which was, it was hard-coded rules in a blockchain that was making the decisions. I understand where a lot of that criticism is coming, because up until 9 months ago, I thought, crypto was fine and dandy. And then I took on a pseudonym and started working on a protocol, getting things listed on exchanges. All of a sudden, exchanges started offering me, expedited services if I just give them $10 million. No contract, just give them, a bit of extra money. Listing teams would offer to split some fees with you, or give you, a kickback or a throwback if you'd promote some other project. If you had enough Twitter followers, exchanges would give you a kickback as well. It was all really gross. And I started to realize that part of the issue right now with crypto is the bar to entry is quite low, and so that has an influx of people right now in the bull market, well, in the previous bull market, wanting to come in. It's a great way to make some quick cash. NFTs, OpenSea made it a lot easier. Now that we're going into a bear market and it's not as easy, most of that is going to die off. I do think that a lot of work is done by journalists to highlight the good of crypto. At least in my bubble, I see a lot of highlight on the good. How many of you read Cointelegraph, CoinDesk, Crypto Briefing, Crypto Slate? There's just tons of good news, all the work that's being done on layer 2s, all of the progression being done there. The bad news is slowly starting to fade, but things like Luna and Terra set us back decades, right? Things like what happened today with Nate getting charged by the FBI for insider trading. It sets us back decades.
Well, not decades, but yeah, it sets us back.
I think decades. I believe that this new bear market that's coming in, I think the SEC, FINRA, and the CTFC in their own ways are going to take time to crack down on crypto. And I'm a little nervous for what's going to happen. And a few of the bigger companies like Block are also concerned about what's going to happen to the Bitcoin industry when that happens. It's coming.
I think what is interesting
It's not coming. I'm sorry, but definitely not decades. Like, I have to disagree. I think that's like that's just not happening. I think what will happen is more criminals and frauds will get exposed, like what happened today, and it'll be harder. It'll be harder to be that. But I think people like in Congress and in governments all over the world look at Bitcoin as actually like a legit, piece of technology that's super innovative and will continue, and Bitcoin will continue to carry this industry on its back for the following decade. So I don't think this has set us back decades. I just disagree.
Do you want to say anything to that? Or, one thing I think is interesting is just even though there always will be, call it this, people doing nefarious things. That happens in any industry, of course, but just the maturity that has happened in the space overall with, call it like grown-ups coming into the room, right? Like last bear market, the grown-ups weren't there. Like the grown-ups that are here now were not there then. And so I'm really excited, that when you see people who are putting, 10% of their wealth or more, who prior to that had been anti-Bitcoin. I think that's super interesting. One real quick thing I just wanted to highlight just on this Web3, Web2 aspect is I think that we just simply need to get to a point where the new, as in Web3, is better than the incumbent or the alternative. And I think we're actually there on, well, we're almost there on one, and I think we're pretty much there on the other. So when you have banks basically saying that the Bitcoin as a payment network is pretty interesting and could replace SWIFT, that's basically something that is better than a legacy product. And then when it comes to NFTs, I don't think we're essentially there at this exact moment in time, but I think we're really close, where an NFT becomes a better JPEG or a PNG. So from a brand context, for example, if a brand is to give anybody here and say like, hey, thank you so much for being a customer, here's a JPEG or a PNG that's password protected and you come to it on our website and view it. Or if they say, oh, here is a file type that shows how many were created, your order in line, when it was created, your ownership rights to it. As a consumer, like, what would you prefer? Sure, you need it to be an easier experience to acquire that, but if you could pick one or the other, I'm pretty sure I know what people would say. So as things become better than the alternative, that's really where I think we start to see the adoption.
Yeah, I think what's really interesting is I'm always looking at things again from like the publicly traded company, and from like the Wall Street perspective is so J.P. Morgan and Goldman Sachs are the two like largest companies that produce research within Wall Street, and so I have access to the institutional section of their websites. We read all this great research. But you have to subscribe, you have to be like an RIA, an institutional investor, and they're doing some really, really good thought pieces, but it's not for the public. And so I see them doing certain things behind closed doors, and then doing other things really in public. And so Goldman Sachs actually last year just did the first ever public issuance on Ethereum. And so, and basically they were able to do it, an IPO, right? And they did it with the Bank of France. And so they were, able to do it much faster and much more efficiently and accurately than they would have if they did a regular syndicate. But that's really not kind of in the news, so to speak, So I think that's really, really interesting too, so.
One additional thing that I might add to this, right, is sometimes it's not necessarily bad for any nascent industry to have these kind of down market or let's call it winters, right? Long winters, short winters, whatever you want to call it. If you look at it on a spectrum of different companies, from like left to right, it's companies that are mission-driven founders with great project founder fit, let's call it. Then you have like the opportunistic founders that are extremely talented, but they're in there because they see an opportunity to make money or to cash in, and so they're there. And they're not doing anything shady. It's just that they're there for a specific reason, more mercenaries. Then you get like a set of founders that don't have a great business model, but because they have a high tide, they can be in this industry and make money. And then all the way to the right, you have the scammers, straight up scammers, bad actors, right? So when the tide is high, generally, and it's milk and honey, you don't see a big difference between these folks, right? Everyone seems to be making money, everyone seems to have, run a proper business, and like you said, Ponzi schemes don't get exposed. As soon as the tide is low, you know exactly what everyone is wearing, right? And the mission-driven founders, even when it's hard and they've lost a lot of money has left the platform, they're so mission-driven because they know exactly why they started the company and what their final destination and target is, and they haven't gotten to the target. So they keep their heads down, hands on keyboard, and keep going. The opportunistic folks, they evaluate the opportunity and figure out, well, am I still going to make money? How long is the winter? Maybe we want to take our resources and do something else. Could be a different crypto project, could be a different Web3 project, or they just go back to Web 2.0. Then you get the people that have a really bad business model. They're exposed and they're essentially pretenders, and they get taken out of the industry. And the scammers now have no money to be made because it's a winter, so they get taken off. So some of these winters are not bad in general for a nascent industry because it really washes away some of the scammers and the pretenders out of the market.
Clearing of the deck. So do you? So in that vein, by that description, and hopefully no darts fly at me. Like, is it a bubble, right? So when kind of the idea of a bubble is in when so many people are in the space, even people that may not be experts in the space, it's kind of flooded, and you just kind of describe that clearing of the deck. Do you what say you about a potential bubble?
Are you asking me, are we in a bubble or were we in a bubble?
Yeah, like particularly as it relates to like crypto, really just like Web3 kind of technology.
Well, there's no question we're in a bubble. Not specifically because of Web3 or whatever, but because the whole broader markets were in a bubble, right? Like the stock markets were in a bubble. We just got out of this pandemic, and I mean, who knows where all this value is coming from? But you've got trillion-dollar companies trading on the stock market. You have protocols that are worth billions of dollars that have really done nothing. And then you have like these Ponzi schemes that are all over the place. So we're in a bubble. The bubble is we're letting the air out, and we need to do that in order to move on to the next bubble. That's just how it is. And when you talk about people getting exposed, they'll be back in 4 years. That's just how these opportunities work. These cycles, I've been through 4 of these cycles. I remember Silk Road, Mt. Gox, the ICO bubble, and now this one. This one is a little different though. This one is different because you actually have real banks, you have real money, real institutional capital coming in, you have real entrepreneurs who ship real products, and then you have real brands, real artists and creators and all sorts of people coming into this space, and many of them will remain and continue to invest in the space. So this is a good bubble.
Maybe more like a combination between a bubble and like a renaissance kind of deal. Take it over to you.
I actually just have a quick question that's slightly off topic, but I love the mission-driven founder thing. I totally agree with that, right? Being anybody here who's a founder, have ever been a founder, like just how freaking hard that is. It's hard, right? I think being a Web3 founder is even harder overall. Just to get some smiles out of the room, what do you all think about Adam Neumann raising for his new crypto carbon credits company? And I think he was a mission-driven founder, definitely, right? You can't deny that about him, but I'm curious what people's thoughts are on that.
Well, I would say Adam Neumann created WeWork, and whether or not you watch the show and you believe everything you saw in the show, he did create something pretty incredible. He may have embellished here and there. He may have been a terrible founder with his money, spending other people's money and that sort of thing. But he did really create something that today exists, and it's publicly traded. And yes, a lot of investors got washed out of it. So with all that said, it's not like I don't want to say like he did nothing wrong, but I would say he created something consequential, and the way he did it may not be the way that I would have done it, or the way, say, any really great entrepreneur may have done it or not done it, but he did it, and so having him get into the Web3 space, I don't know, I don't really care, I guess.
I think A16Z has massive balls for funding him. Oh, sorry, am I not allowed to be Australian on this? I think he has balls coming, back out, creating his own blockchain project. Not really sure why he needed a separate blockchain of his own to launch carbon credits. I'm kind of surprised he didn't just build it on Bitcoin, which would have been impactful, or Ethereum would have been cooler to see. I think him and Martin Shkreli, if I'm pronouncing it right, coming back out of prison and jumping immediately into crypto, are kind of the 2 horsemen out of the 4 horsemen of the crypto apocalypse, and I'm looking forward to seeing who comes next. Look, I think it's a sign that we're coming into a bear market, and it's okay. Crypto is a little weird. Crypto, attracts all sorts of people, and I think the one thing crypto does really well is information propagates a lot faster than, in my experience, in traditional markets. And I think that people are just going to kind of educate each other through Twitter, social media, about maybe why you shouldn't touch Adam Neumann's new fancy blockchain project, and maybe why it's not a trusted solution. And I think that's a good thing for crypto in general, that investors can be quickly educated. I've not seen that kind of education level with traditional stocks.
And so I have a slightly different take on that. So I don't know if it's big balls or big fund size with deployment challenges. I think that's what it is, really. Like, how many funds do you see that are like multi-billion-dollar blockchain crypto funds? It's hard to deploy that kind of money, right? Like, most of the projects that you see are looking for, I don't know, 10, 20, 50 million dollars at tops on their project. And so to get someone that is, let's call it, tried and tested founder that can potentially manage a multi-billion-dollar, multi-tens of hundreds of billion-dollar valuation company, it almost feels like that's the only like big swing that they can take, because all the other projects they'd have to write smaller checks just based on the size of the project.
Well, I would say this. So having been in the venture space, and I've worked with hundreds of VCs helping companies raise money at Microsoft Ventures. And my last VC, by the way, our lead VC at Unicorn, was the face of the Me Too movement in Silicon Valley. It was a complete disaster. Like, one of the partners did all kinds of inappropriate shit, and they had to shut down the fund and give it to another venture partner. Basically, our fund sucked, and we were running rudderless for a while. I'm working with A16Z right now, and I have to say, they are by far and away the best VC that I have ever worked with. They keep promises and they deliver. Like, when it comes to regulatory, when it comes to PR and marketing help, recruiting help, just everything. Their bench is very strong. So, and they're super smart, like very capable people. I had to ask myself the same question, like, why did they do this? And I remember about a month ago, I went to dinner with one of the partners at A16Z, and we were talking about the 3 shows. We were talking about the Theranos show, the Dropout, we talked about We Crashed, and we talked about Super Pumped, and the differences between the entrepreneurs. And like we're having the conversation about Adam Neumann, and I thought, this is a really interesting take on the whole thing. I wonder what's going to happen next, and then this happened. So I would just say that there's such a good VC that maybe they know something I don't. So.
Yeah, and they're very data focused as well. They take a data focused approach to their investments, historical data and things like that, of course.
I love all the different ways we went in this conversation. So everybody, thank you so much for joining this call. I'm used to being on a Zoom right now. Thanks for being on the Zoom, everybody. So please give our panelists a round of applause.